Hey, what is going on, guys? Edward here, back with another video. This time, I wanted to discuss with you and show you the three most common liquidity traps for smart money concepts. And I would say in trading overall, as price action, and there are different types of liquidity. People in this type of concept, they tend to put different names to this. They call it inducement, liquidity traps, liquidity grab. Um, they put it so many names. At the end of the day, is basically the same thing, right? I think they also call it engineered liquidity and all this stuff. Like it's all with the algorithm and this stuff, but it's all the same thing. It's basically the money, the markets taking money from traders like us, right? And using it as fuel to then move to a certain direction. Okay. So liquidity is just fuel. I can actually just put this thing here. So um, liquidity equals fuel. I'm just gonna put it here. I just didn't put it at the beginning, but I'm just gonna put this as an example, right? Once the market takes liquidity, you will notice most of the times that once the market is taking liquidity, or stopping people out. Okay, I will explain that as well because still people don't understand what okay, maybe they understand the word, but what does it mean on the chart, right? So when a market take liquidity, they use that as fuel to go to a certain direction. It could be bullish or bearish. All right. Um, in the first scenario that I'm going to show you right here, a the first thing we can see in this chart, in this drawing right here, we see that the market had a nice push to the upside, a little correction, right, and had another push to the upside, right. In terms of smart money concept, people will call this a boss, a break of a structure, right here, okay, right there. In reality, this is not a break of a structure because the market needs to take liquidity, right? It needs to take fuel before actually completes the move, okay? Or it goes to a certain direction. All right. In this particular scenario right here, this is not a break of a structure. Even though it's breaking that last side, it's not a break of a structure. This is called inducement. Okay. Inducement, it's another word for liquidity. Okay. Why is that? Inducement is basically the word means that it's inducing people to buy. In this case, it's right here, the market, it's inducing buyers to get into trades, most likely aggressive traders. I'm sure that there is some traders right here just basically once it broke that resistance, the price broke that resistance, aggressive retail traders, they will most likely be buying right away, right? So, and they will place their stop loss just below the zone, right? That's normally what a retail trader does, right? And then they aim, let's say, a 1 to 4, whatever risk reward they're aiming right there. But you see what the market is doing. The market is not ready to go, like, to complete the actual move that it's looking for. I hope it makes sense. So it's not ready to move up yet, right? So be careful when you see that the market has not taken like any liquidity, and I will explain this in this move. Be careful with that because if the price is just breaking right here, this previous high, just gotta watch what happened here and this move. What happened? Because if there was not like any liquidity being taken out before the price broke this high, it's just a fake breakup. Okay, so this is a little trap. Okay, little manipulation right here, little trap to induce buyers to jump in early in this entry, in this buy right there. They get very excited, the price is pushing, but then all of a sudden, boom, drops and it stops them out, right? If it's stopping them out, guess what? The market is just taking liquidity by stopping these guys out, right? So it's taking liquidity. So it's starting to build to, once it's wiping people out, stopping people out right here, it's taking liquidity. Okay, the markets are getting liquidity right here, right? Not just that. Look at what's also happening, like right here from this low. Look what the market does, right? The price drops right there and breaks below this previous low. Once the market is doing that, what do you think this is called? This is actually another inducement. Why? Because now it's inducing sellers. This time it's inducing sellers, right? To jump into trades. Let's say maybe this guy right here who was buying, right, in the first place, he was buying right here, right? In the place, the stop below. So he got stopped out on this one, and holy shit, they got mad, right? Oh, we got stopped out, man. I got stopped out on this one. Crap. Let's see what the market is going to do now. All right, now the market see that the market is actually breaking this low, right? And they're like, "Oh, I get it, I get it. Yeah, I'm so stupid. Yeah, I fell for the trap, right?" So the market really doesn't want to go up. The market wants to actually go down. So as soon as they see the break of this low, they're gonna be jumping in aggressively again, most likely, and they're gonna be aiming their targets somewhere there. Just an example, right? Guess what? The market is not ready to go down, right? It doesn't have the actual direction yet. It's just inducing. The market, what is doing here is taking liquidity. After that liquidity was taken, price now is pushing up and finally breaking this structure, which is called the BOS. This is the, in fact, break of a structure happening there. Now, once that break of a structure happens, the break is also causing a lot of buyers to get in. It's still inducing. Like you can call this inducement or break of a structure. It's the same. Basically, the market is breaking. Once the market breaks a high or breaks or a low, for example, instantly. It's not just you. All like a bunch of traders are actually looking to buy aggressively, even if the structure is broken to the upside or to the downside. So this right here, it's even like the market is actually going to be taking liquidity from these guys who are buying. Most likely, they're actually buying here. They place a stop a few pips below, or maybe below this low. They say, "Oh, yeah, I'm gonna put it below that low, and I'm gonna go like that." Yeah, let's go. No, doesn't happen. The market is not going to push up yet. It's taking liquidity over and over again. What the market does is comes back down. Guess what? Induces again, right? It's taking liquidity from those lows right there, right? Below those lows, there's money sitting, right? Or above the highs, there's always money sitting because that's where people put the stop loss. Even if they bought there, maybe they were placing the stops right here also, right? So there's normally a lot of money sitting below every single low and every buy, every high. There's normally stop losses in there. Okay, so what the market is doing here is just coming back down, taking that liquidity, more money, right? And the price will then push up. Normally, a smart money trader, what they do is they wait for that trap to happen. Normally, we're looking for an order block to be formed either here, like a POI or origin, and we look for the buys like when the market is getting into the actual order blocks so we can take the most out of this thing, right? I'm not saying that order blocks is the best and is the only thing that works, right? That you can only make money with the smart money concept. No, you can still make money being a retail trader and still, right? But understand why when you get stopped out, you understand why you got stopped out. Market is just uh, taking liquidity and creating this type of movements, right? Inducing all the time. All right, you have to understand the process. So inducement equals liquidity equals fuel. Okay, it's basically the same thing. All right, this is kind of like the first scenario on type of liquidity right there. Most common liquidity, and the other end, basically we have right here, right? Market is consolidating, just going in a range, right? We know that when the market is consolidating like that, simple, the market is building up liquidity above those highs and below these lows. Very simple. Why? Stop loss, right? All the stop losses. This is a very strong resistance right here, and this is a very strong support. So there is simultaneously a lot of buyers trying to get in there, maybe, you know, trying aiming their targets there, right? Buyers getting in here, buyers getting in here, right? The more the market consolidates, the more money is being placed below those lows. So you don't need to actually have like a computer or to be so smart to understand that above those highs, there's most likely thousands of dollars, right? Hundreds, maybe millions of dollars in there, right? The same as below these lows. So the market makers, what they will do, or this algorithm, is they will try to, boom, they will swipe them at some point. They will push up, liquidate all these guys, right? Take the fuel from here, and then maybe sometimes the market will just maybe skyrocket right away, or it will come back down, right? To now, after swiping these sellers out, now the market will come back down to swipe these early buyers out, right? And now is when the price is going to move up, right? This is doing a lot of things here. The market is even inducing. The market is even inducing buyers. After the buyers will see the break of this structure right here, they will be like, oh shit, yeah, this is the break of that consolidation. Let's go buy. Boom. They go buying in there. Guess what? No, market is not ready to go up. So boom, they get stopped out. More liquidity is taken there. Market then another couple of traders, maybe a couple of thousand more traders, they will see, oh, price. Yeah, I see the trap right there. The market was trying to go up, but now it's going to go down. Yeah, look, it's actually breaking the structure to the downside. Yes, let's see. Let's get it. This time I'm gonna risk more because I lost this one right here. I'm gonna double my lot size on this one. All right, let's get it. So boom, you enter right there. Next thing you know, boom, you get stopped up, right? Because you are so eager to jump into the markets. So this is liquidity. Okay, market is just stopping people out, getting liquidity, getting fuel. Once once it make a lot of money from here and here, right? Inducing sellers, inducing buyers, stopping these guys out and these guys out, boom, let's go. That we're going up, right? So it happens, right? This type of trend right here, we can also see the market broke this high and so on. So basically, price is pushing up, and we see that this could be called trendline liquidity. Is basically the same, right? It's just the market is just building up, is pushing up and building up liquidity below this lows. This is all liquidity, right? Sit the market before it continues pushing up, it will come back down, boom, taking these lows out, even this lows out right here to perhaps mitigate something that was over here, right? Mitigates the order block, and then we go buy, right? That's what a smart money concept trader look for. They normally look for, or just wait for the manipulation to come in, right? And to the liquidity to show up, right? And they wait, right? We simply wait for that. And one thing that you can also see here is basically the same. We just see liquidity right here. You see liquidity right here. The market will most likely sometimes it will show you an order block at the top and an order block at the bottom, something like that, right? So market will stop these guys out, right? Take this liquidity out, boom. After stopping them out, we'll mitigate the order block right there, and then that sale will come from here to this order block, which is going to be wiping these guys out as well, right? Taking those that liquidity in there before actually going the direction we were going to, which is bullish, right? That's basically it. Okay, inducement, liquidity is just fuel, stop losses. All right. Now, let me just go right quick here just to show you a couple of examples on US 30. For example, guys, whenever you are back testing this type of thing and you want to see where the liquidity is, especially, let me give you this tip, and maybe you don't know, maybe you already know. Asian session. This is why people don't trade Asian session, because Asian session normally the markets consolidate. I'm giving you an example here on US 30. So as you can see right here, I'm just highlighting New York session and London session, right? So it's this entire zone. What's happening when we are outside London session and New York session? Look at what's happening. Market is consolidating, right? On a weird way, yeah, I know sometimes it's going like that, but it is in this case, yeah. Let's go from here. Market was building up that liquidity, right? Just simply going on a range, it's moving sideways. What the market does, you see the dirty move right there, right? The market goes lower and this low right there, to just to take all this money. It's like, yeah, let's go ahead and wipe them out, right? Let's take all the money that was created from Asian session, those people who are actually trying to look for buys and they are still holding their buy positions. And no, let's go ahead and stop them out. Why? Remember, stop losses from, let's say, people who is buying here, then most likely they have their stop losses somewhere below that low, right? Just an example. And maybe, there's a lot of people just buying there, buying and buying and buying, you see multiplying. So this is all filled with positions, right? Holding positions in there. So market is simple. Market makers or the algorithm, it will pretend it's going up. Everybody gets excited. No, New York Stock Exchange opens. Woof. Volume comes to the downside, manipulation out of nowhere, and the actual direction was actually bullish. Then you will be like, what the hell just happened here? I was on this buy, and that shit is like, they know where my stop losses are. Yes, sir. Everybody knows. If you're into a range and you're holding buys, come on, you know you are in a dangerous position. So if you're either not on break even or you are just holding, you're gonna get stopped up right here. Liquidity, Asian session. Again, market is just ranging right here, right? What the market does, look, it pushes up before it goes down. So it's taking this liquidity out. It's wiping all these guys from Asian session right there. Boom. And actually starts going down. Why? Because it needed to take this liquidity as well. So it needed to liquidate the guys from Asian session. Sometimes even London session partially. It will wipe them out, but especially Asian. And not just that, the market got lower and deeper. And look, the market was creating this little support, right? We can say this was a range right here. Market was also like, let's say, consolidating in this range right here, right? But what the market does before it starts skyrocketing, guess what? It's going to create a very deep low right here, even taking that last low below this support. There's hundreds of thousands of entries right here, right? From a lot of buyers seeing already, yeah, man, this is actually going to push up. It's just taking, so long. So I'm going to swing trade. All right. People, more buys in there and more buys in here with that engulfing, right? To place the stop loss below that low just in case. Yeah, well, here's your just in case right there. Boom, price will just come down a little bit more, a little lower than your stop loss and get you out. And that's it, right? Market tends to consolidate, right, during Asian, especially during Asian. Not all the time. We can see sometimes consolidation during London session or New York, depending on what's happening. Sometimes the consolidations can be very big or small, depending on the day, what's going on. Like we see a consolidation right here, right? But if you use these examples, guys, you can simply see. Look at the manipulation here. Look at this manipulation. Market consolidating here, right? Look, before it crashes down, right, which would have been an amazing sale, right, for people who were holding sales from here, from Asian and London, guess what? Price will go up first, right? Stop you out, even induce buyers to jump in, right? And no, we're not gonna go up, and it melts down, right? And it's like that, right? It's very rare when the markets actually go to a certain direction, up or down, during Asian session, but more often than not, the market will actually go in range, right? Because there's not much volume during Asian session, right? Normally, a lot of people starts getting in either London or New York. So I hope it makes sense, guys. And now you understand a little bit more about liquid. Just look at this, just liquidity and um, just the market just taking liquidity from us pretty much to move the market and acting as fuel. So if you guys like this type of content, please give it a big thumbs up. It motivates me to keep posting videos like this. If you're new on the channel, please subscribe. Follow me on Telegram. The links is in the description below. And I'll see you guys in the next one. Take it easy, guys.